Okay. Hi, Jake. Thank you so much for joining me here. This is the first time like I'm doing this Chat with Super Traders episode with someone from the States. So I'm really, really
Hey,
grateful for you and thank you so much.
hey, thank you for having me. Looking forward to talking about trading and some of the issues I've had in the past and even still have. It would be dumb for me to say that I'm a perfect trader or anything like that, even still today. So trading's all about learning, and as you change as a person, your trading styles change. Some of those are good, some of those are bad. So looking forward to discussing all of the above.
Perfect, perfect. So can you give a brief intro for yourself? Like when did you start and what was your trading strategy, what was trading style when you started and how has it modified over the years?
Yep. So I started. It's hard to say if I started trading. I guess I was a market participant back when I was 12 years old. My
Okay.
dad wanted me to start looking at the stock market and some different stocks, and he would be the custodian for the account. So yeah, I wouldn't say I was like a trader or anything. I mean, I was looking at stocks, looking at line charts, not necessarily technical charts like candles and that thing. And like most people, I blew up my account pretty quick, as kind of somebody who went to school as a freshman and heard my buddy talking to me about, or my buddy was talking to me about how his dad was in this penny stock, this oil and gas penny stock. And I'm like, oh, I got to go all in. This is going to be amazing. And, um, you know, quickly realized that that's not the way to do it. He probably wanted me to go in it just so there'd be other buyers of the stock. It's like an OTC stock. And it was just a really eye-opening experience to realize, like, okay, maybe I shouldn't be trading something that's 0.001 pennies. So that happened. That was about $1,000 account, and I just kind of blew it up. And then in high school, 2008, 2009 came around, and that's when I started trading some of my mom's money, as well as I think she gave me 200 shares of something called XL Capital when I was like 16 years old, and um, I traded that, made quite a bit of money, and then went right back to what I did at first, and that was kind of just got too greedy, tried to make some big wins, and got hit pretty hard there. But thankfully, we traded her account differently, and we were able to cash out pretty well. Once 2009 2010 hit, I went to college, didn't trade a ton. I was more focused on my studies. I still kept with the markets, and once I graduated, I kind of went back to trading. Took a little bit of the money that we had made in 2008, 2009, and made a bad bet trying to short the market. Realized from there that the Federal Reserve doesn't always have to do what they say they're going to do. Janet Yellen in 2016 said she was going to raise rates like 4 different times, and that just didn't happen. So she kept them the same. The market kept going up. My short position kept going down. Um, Thankfully, I did get out during the Brexit crash in late June of 2016, and licked my wounds and moved on, and really kind of went back to just focusing on just learning about myself more as a trader. And I think that's what a lot of people don't realize is trading's really about learning about how you react to things. Are you someone that's going to get so into a trade that you're literally just going to go all in and just not be able to look at other things and in a perspective that may help you out? So I still will make these mistakes even today. I think it's something that I'm 28 years old. I probably won't really ever get trading down perfectly because things change, the market changes, your personality changes, your where you are in life changes. But I think really a big part of trading is one, finding a strategy that works for you, finding a technical strategy that works for you, whether that's using candlesticks, whether that's using a line chart, and really the biggest thing is managing risk. And that's something that a lot of people have trouble with, managing risk and sticking to a plan. And so as a trader, those are two things that have really changed the way I look at the markets: is sticking to your plan, managing your risk, Have I gotten lucky going too heavy in a position and then it went up? Yes, but over time that's not necessarily the way you consistently make money. So it's one of those things where I constantly work on every day and try to just do what fits my personality, which may not be for someone else who has a different style, and that's what really makes the market go round.
Perfect, perfect. And like we were already like discussing about, you look at some different type of charts. You look at raindrop candlesticks, and
Mm-hmm.
then you look at something called as volume shelves. So we will
Mm-hmm.
definitely want to see that also. Like, how did you decide to like you will start focusing on those things? Because as far as I believe, 99% of the traders in India, they are not aware of raindrop charts till now.
Mm-hmm.
So like it would be
Yeah.
really
So
useful.
a lot of before I share my screen, a lot of things in the market and that I use today, like raindrop charts or anchored volume by price, which is where you can identify different levels of supply and demand zones, which sometimes I'll call volume shelves.
Right,
These are all things that I tried to do at an earlier age, but there's only so many tools that you can use to really do this. And so once raindrops were invented by our team, I was able to, instead of going to a 2-minute or a 5-minute chart trying to figure out where blocks of volume were coming in at a specific price, I was able to use the raindrop charts to visualize that within one chart. So should I go ahead and share my screen and explain that a little more and how to use these?
yeah, please, I will make you the host, then you can share your screen.
All right, perfect. So raindrop charts are something that are very different when you first look at them. So if you can see my screen, a raindrop
Yes.
chart is essentially a volume-based candle. Now, that doesn't mean that I don't use regular candlesticks. I actually use raindrops with candlesticks side by side, and we'll go over a couple examples of that here shortly. But the raindrop chart, as I mentioned, is a volume-based candle. So if you're familiar with a typical bar chart, the
Right.
first layer to this candle, minus all these little squiggly lines, forget about those. Those are the volume profile. We'll get into those in a second. But if
Right.
you're just looking at a regular candle, your left bar here and your right bar here, if you're looking at a regular candle, this is your open, this is your close, this is your high up here, this is your low down here.
Right.
Now, with the raindrop, instead of this being your open on the left and your close on the right, the left is your volume weighted average price for the first half of the period, whether that's the day, whether that's a 30-minute chart. So
Right.
the left bar is a volume weighted average price for the first half of the period. The right bar is a volume weighted average price for the second half of the period. And so that's something that, initially people see that and they're like, what does that even mean? It's really looking at what buyers and sellers are doing. Are buyers in control versus the first half of the period with the VWAP? So that's what really helps us ignore open and close, which a lot of the time can be pretty arbitrary. Where a stock opens versus where it closes is important now because everybody looks at it. It's kind of like a self-fulfilling prophecy. But at the end of the day, the raindrop is really telling us who's in control, buyers or sellers, using that VWAP. Now, the second part of this candle is the volume profile. You can see here on the left, this
Right.
volume profile kind of overlays onto this little bar here, which is the volume weighted average price.
Right.
So this will tell us where shares were traded during the left-hand side of the candle, i.e. the first half of the candle. So here you can see most of the volume was focused near the low of the day, and you had a very, very small amount of volume that was here. It was almost barely noticeable, but you can see that during the second half of the day, most of that volume was near the top of the range. And you can see this whole part is flat on the left. So that tells
Right.
us that there was no volume taking place at this part of the candle. We know during the second half of the period, let's say the second half of the day, if we're looking at a daily chart, a lot of that volume came into play and actually pushed prices higher intraday than they were during the first half of the period. So this really tells us about volume flow. It tells us about where are buyers actually absorbing supply, because this volume is just volume. You have to have a buyer, you have to have a seller for volume to show up. So these candles are telling us where are buyers actually stepping in and absorbing supply, i.e., where are these shares being sold, where are people coming in and actually buying them up. So the point of the raindrop is really to visualize that volume flow throughout a candle. And there's a lot of different ways you can use this, both comparing these to a regular candle to look for discrepancies, whether that's you having a green raindrop versus a red candle, or having a big wick and then seeing that maybe there is volume in that wick, or maybe there's not volume in that wick. So I'll go over that here in a second, but just to go over the different colors of the raindrops, the bullish raindrop, or just a green raindrop, is going to be when your volume weighted average price for the second half of the candle is higher than the first half. So as I mentioned, if you're familiar with the bar chart, the left-hand side is your open, the right-hand side is your close. If your right-hand bar is higher than the left-hand bar, it's going to close green. And that's what we have here, except it's VWAP instead of open and close. Neutral raindrop is essentially a volume-based doji. So rather than having an open and close equal the same exact price, you have your volume weighted average price for the first half and the second half of the period equaling each other. So it's really a volume-based doji, and it's something that's really powerful because you're able to essentially get an idea of possibly where reversals are coming, where continuation is coming, that type of thing. Bearish raindrop is just the opposite of the bullish, where your volume weighted average price for the second half of the day or second half of the period is lower than the first half of the period. And so it's just the opposite of a bullish raindrop.
So we
Now,
can
this is
say
an
like
example.
this, like if there is a breakout coming, and if a normal candlestick is coming out of the breakout, so over here we can see that actually if the breakout is supported by volume or not at the second half of the day, if it's a daily candle. So we can like figure out if it's a false breakout or it's a true breakout. We can this can help over there.
Yep, no, definitely. So the biggest thing about this is the fact that, a bullish raindrop just means that it's green. It doesn't necessarily always mean that it's going to continue up the next day. It's just telling us that the volume weighted average price for the second half of the period is higher than the first. And so I can go over an example here of hollow candles versus raindrops, and we'll go into an example of using this theory around resistance and support. So you can see here that on the top we have hollow candle versus raindrop bearish. So you can see here this is your daily candle. This was back in, I think, mid-June for Amazon. You can see this candle has a really big wick here. However, the raindrop is confirming within this wick that there was not a lot of volume taking place. Because if there were actual, convicted buyers that actually have conviction to come in and make a trade and absorb supply, you'd have a big chunk of volume up here. So compare this candle where you have a wick and you have the raindrop confirming that there's no volume to this candle here where you have a wick, but you also have volume within that wick.
Yes.
So even though that there was a sell-off into the end of the day or end of the 30-minute candle, we can see that, sure, the wick is showing us possibly, that there was an increase in supply versus demand, or maybe just relatively speaking, supply was higher than demand, pushing the price down. However, you look at this candle here, and you can see for any of those sellers that came in and pushed the price down, there were buyers absorbing supply at the top of this range. So if you go to a chart and you kind of look at how to use this, this is an example on Netflix where we have this clear level of resistance. It was resistance multiple times back in 2019. Right. And then finally, the price was able to break through. Now, if you look at the hollow candle, you'll see here that we pretty much closed right at this resistance zone. So if you're just using candles and you're not necessarily thinking about, okay, well, was there actually any volume up in this range? Generally, you would need to go to the 5-minute candle or the 2-minute candle to see where was that volume coming in the smaller time frames to kind of measure that. Whereas with the raindrop, we just turn on the raindrop and we can see there was quite a bit of conviction by buyers above this area. Because if there weren't any buyers, if there wasn't any conviction here, remember, it's not necessarily this is buying volume, but we know that there were buyers above this line because of this big chunk of volume here. So anytime that you see a breakout through resistance with a big bulge of volume above the resistance zone, that is a good indication that there is conviction by buyers above a breakout zone. So here, if you're just looking at the candle, it's not necessarily the most convincing thing with this wick here, and you have a close right at the resistance bar. But then you see the raindrop, you see the big bulge, and you see both the volume weighted average price for the second and the first and the second half of the day were both above this resistance line as well. So it's really showing us what's going on the supply and demand side versus what's going on versus the open and the close. And that can really tell you a lot. Now, if we go to an opposite example on Apple, this was from a couple weeks ago and is really, really crucial, right? So we've got this area of resistance, once again, multiple times acting as resistance. We finally tried to break out here. And yes, this is a very ugly candle to start with. That is not what I would call bullish at all. However, what we can go in and see is the actual raindrop as well. Notice there was no volume up here. It was completely flat. So we know that even though the price did break through this resistance zone, there was really no volume or conviction by the buyers up here absorbing any of that supply. And if there was, we would have seen that bulge of volume like we did on Netflix. Right. So it's something that's really crucial because you're able to get an inside view of what's going on within that candle on the supply and demand side.
Right. Perfect. Perfect.
So raindrops are a way to make the whole process of looking at volume and supply and demand more efficient, and really allows you to not have to go into those smaller time frames to see where these volume blocks are coming in. You're able to see the overall flow of volume within the raindrop, and that's something that really helps, especially when you use these side by side. You can see really a big difference here. And so another thing that's interesting, if you go to something like silver, this was a cool case study a couple weeks ago where silver had a hollow candle here telling us that from the open, buyers were in control versus the close. So here we opened at around 26.60, we closed at 27 or so, and you can see here that, you know, this doesn't look horrible if you're looking at candles. Now, if you look at the raindrop, you'll see that this was actually a completely different color. So you had a red raindrop versus a hollow candle. So this is what I would call a discrepancy between the open and the close action versus what's actually going on between buyers and sellers throughout the day. So being able to look for these discrepancies where you have a green candle but a red raindrop, or, you know, a red candle but a green raindrop, really helps you get an idea of, you know, is there confluence between the candle and the raindrop, or is it telling us two different things? And so that's another great way to use these two things together. So it's not like I don't use candles anymore. I just have raindrops there to look at candles with hollow candles, so I can get a better idea of what's really going on there. So definitely something that it will take a little time to get an idea of what's going on, but overall it is something that really can make the whole process of looking at supply and demand more efficient. Now, there is another way to look at supply and demand in a more efficient way. So if we go to the anchored volume by price, now the anchored volume by price is, you know, similar to the volume profile. It's a little different, but essentially what you're doing here, especially on TrendSpider, which makes this unique, is the ability to actually move this visually. So a lot of different software platforms you're going to use generally are going to start your volume profile just from whatever candle is starting here in the history. So I scrolled back and happened to start this chart on March 2nd. But if we look back, March 2nd is not an important level. It's not a reversal point. It's just a candle. So when you're anchoring the volume by price, or you're anchoring the VWAP, which is what we'll go into in a second, you really want to start the volume profile from capitulation points, or from tops, or from, you know, a pivot point. So what we can see here is, you know, we can see all of these different volume nodes. So all of these different bars of volume are just telling us how many shares are holding at a specific price level. So the width of this bar is just telling us that, in this case, if we draw this line, we're measuring the volume from let's say around 311, and then we're measuring it up to around 314. So we know what the volume distribution is of these shares from 311 to 314. We know there's a decent amount of shares. We can also look here today and see that there are a ton of shares holding from around 320 to around 322.50 or so. And so what that does is it helps us get an idea of where are a majority of shares holding at a break even, or where are a majority of shares holding at a profit. So what we can see here, if we anchor the volume by price from this capitulation point in March, this is pretty much where all the markets bottomed. We want to know where is the volume distribution. So we can see here, this was an initial level of interest for buyers. Once the price really took a big dive back in early September, a majority of these days were kind of bouncing up and down through what we call a volume shelf, which is an area of volume that a lot of people are holding at. So today, for example, this is a great example here. This next volume shelf that I have highlighted, there were a lot of people holding from around 320 to around 322.50. So when the price is way up, even up here, when the price was trading up here the last couple weeks, some of these holders were up, 5-6% on their SPY position. But as the price comes back down to where they bought it, they now have no profit. They have no profit margin to work with. So it's a lot easier for them to just hold here than to sell up here, because it's easy to sell if you have profit. You just lock in your profit and you forget about it. However, if the price really gets back to your break-even zone, what are you going to do? You're probably not going to sell. You're probably going to hold. Who knows? Maybe you're going to add to your position. But that level changes the supply and demand, because now this big block of shares are back to break even, and that is exactly what happened today. We fell right into this volume shelf. A majority of these shares were back to break even. And remember, price doesn't always have to go down or up because price doesn't have to always go up because you need more buyers. Sometimes price can go up just because sellers are drying up. There's no more sellers, so you don't have any of that selling pressure to push the price down further. So this is a good case of maybe there just wasn't an increase in buyers for this little pop today. Maybe people just stopped selling, and that allows the price to also move up based on the supply and demand curves. We do have a video looking at the supply and demand curves and exactly how these movements work. If you're interested, just type in TrendSpider supply and demand curves on YouTube, and you can check out that video. And if you do want to try this software out, you can sign up in the link in the description here to try some of these things out.
Yeah, I'll put the link of your video also, and I'll put the link of the software also, so that's
beautiful.
Fine. Yeah.
Fantastic. Well, thank you.
If you can see the volume shelf, today's volume shelf. So if we can see a few points below, there is also a big volume shelf, not as big as today's, but even that one is a bit. So we can say that it can also come to that volume shelf also.
Yeah, 100%. Just because there's a volume shelf here does not mean that the price can't go lower. It's just telling us that we're at an area where a lot of people are holding at break even, which is possibly going to change the dynamics of supply and demand. Now, what's also interesting here is notice I have this volume gap, and notice that the price was able to drop very quickly from around 333 down to this 322 area. And that's because there just wasn't a lot of shares traded within this area. I call this a volume gap because look at the gap. There's no holders within this area. So as the price is dropping, there's really no friction for price. It's just going to drop to the next break-even zone, which is this next volume shelf. And you can also see here, if the price did break down, we have another volume gap from around 320 to around 315. So if the price couldn't catch a bid at this current volume shelf, it would be very easy for the price to break down through this area and then possibly catch a bid at the 310s, 308 area. However, today we can see that the price is trying to catch a bid here. The question is, will it hold? Initially, it held at this first volume shelf before breaking down. So what's really interesting about this is even even though the price can break down through this area very quickly, it can also move up very quickly because you don't have a lot of friction until we get back to this 335. So remember, from a psychological standpoint, all of these shares at 335 that are holding here are now holding at a loss. So as the price, if it goes back up through this volume shelf back to this, what I would call supply area, because remember, these shares are holding at a loss right now. So as the price gets back to this supply zone, they're back to break even. And maybe at this point, they're like, well, I'm going to take my money and put it in a different part of the market that has a higher opportunity cost. Maybe people are chasing some of these, COVID plays like, Piton or Fastly or Roku or something like that.
APT is also.
Yep.
Yeah.
Yep. Exactly. So, it's all about opportunity cost in the market. Can you still make money on S&P 500 from here? Sure, possibly, but maybe you find a different stock that you think you can make money quicker or even more of a percentage ROI gain. So it's really about the psychology of the market. As people start to break back, even if the market went to the mid 330s again, then that essentially tells us that there's going to be some people that do sell at break even and just move on. And that changes the dynamic of supply and demand, at least at first. And then sometimes you will have, a continuation. Now, before we move on to the anchored volume weighted average price from Brian Shannon from Alpha Trends, I want to go over this example. So remember, you don't always have to anchor the volume profile from this bottom. Maybe we want to anchor it from this pivot point before the next move up. And you'll see something that it was exactly what we were just talking about on SPY here on IWM. Notice what happened. The price was able to move down very quickly through this volume gap. It moved down right to this trend line support. So that's confluence of trend line support. But you also had this big shelf of volume holding here. And so we caught a bid here. And then notice how quickly the price was able to move back through this area because there's just not a lot of participants in the market until we got back up to this area. And so what happened? A lot of people broke even. They're like, all right, I'm getting out of the market. The market reverses, and the price is able to drop very quickly back through this volume shelf. And take a look at where we're catching a bid. Right at this trend line support, but also right at this big shelf of volume again.
Right.
So you'll see the price likes to, if you're familiar with the game pinball, just go back and forth like a pinball, just kind of bouncing off of these levels. And so
this is exactly what I can do right now after a few days. Yeah.
Yep. Yeah, and it allows you to see where these supply and demand zones are, and by highlighting these areas, you'll see how crucial these levels are for price to either catch a bid or see some sellers come into play. So this is a really cool example over the last couple of weeks that I wanted to point out with that volume, shelf and supply zone, that type of thing. Now, this is just one dynamic. We're anchoring the volume by price. Now, what if we want to anchor the volume weighted average price? A lot of people look at the volume weighted average price and they generally are looking at it as like a moving average. Like you're looking at the 14-day VWAP. So that means you're looking at the VWAP from the last 14 days and it's just kind of a continuous line. That's great, but there's times in the market where a buyer becomes a seller or a seller becomes a buyer. So for example here, we bottomed out here on AMD on June 29th. And you'll notice here that this was the point that essentially anyone who was a seller capitulated before the next leg up. And so the way Brian Shannon teaches how to use the anchored VWAP is essentially looking for these reversal points and starting a VWAP from there. Because who knows, maybe in early June you were a seller of AMD. And then finally, once this reversal candle hit, maybe you became a buyer. And so the dynamic of the participants in the market changed at this point. So that's where we want to start our volume weighted average price from. So you'll see here, if we start the volume weighted average price from this June 29th low, you'll see how well that the price action respected this area. Now, obviously, there was a little bit of a breakdown before reversing on July 14th, and then the price continued to respect this area. Now, look what happened here. The price did not actually hit this area before reversing today. So the question becomes, how do I take into account these levels but have some type of margin of error? So if you listen to a lot of the pros out there, with a trend line or with a moving average, you generally want to draw these things with a highlighter or a crayon rather than a pencil, because price is not perfect. You're going to have areas where price overshoots. You're going to have areas where price undershoots. This is an example where the price reversed before it was actually able to get to this VWAP. So we have a couple ways to battle that. We have the sensitivity on our alerts. So let's say that you wanted to create an alert on AMD whenever the price was getting close to this area. You're able to create what's called a sensitivity zone. So you're able to define not only I want to be alerted at this specific line, I also want to be alerted within, X amount of dollars. Here it says alert fires within $1.92 of the selected line. So then you don't have to go stare at the screen all day and see, oh, we're like 20 cents away from this line. I'm not going to buy until 20 cents happens. Or you set an alert, you define your zone, and that's half of the problem that we talked about at the beginning of this video, was sticking to a plan. Right. If you just start buying because you get bored, you're not sticking to a plan. You're just buying to buy. So being able to define these areas both to the downside and the upside allows you to define your criteria that you want to participate in this trade, and then you're able to go from there. So this really allows you to define your criteria, go do whatever you need to do during the day, and then when you get close to this area, you'll get a text message or you'll get an email to know that, all right, maybe it's time to get back to the computer and make a trade. So the sensitivity zone really allows you to do that. But let's say that you don't want to be alerted. Maybe you just want to do technical analysis and maybe share this content on Twitter, to your audience. You can also do something called percentage offsets, where you go into the properties tab here and you can actually change what's called bands. So a band is like a Bollinger Band, right? Bollinger Bands are a percentage or a standard deviation away from the 20 moving average, the 20-day simple moving average, or the whatever time period you're on. With the bands, I could go to percentage here and I can say, all right, I want to add a 1% band above the current VWAP that we're highlighting. Very similar to what we just did with the sensitivity. So if I do level 1 as 1, that means I'm adding another VWAP 1% above the VWAP that we have on the platform. And you'll see here what happens. We're able to take into account some of that margin of error, and you can see how well the price has now respected this 1% offset. Whereas if we got rid of that 1% offset, you can see that the price did not actually bounce where we thought it would. So being able to add some margin of error around these lines, whether that's a moving average, whether that's an anchored VWAP, this really allows you to do that. And so before I kind of stop talking about the anchored VWAP, this is a great example of how Brian Shannon uses what's called the anchored VWAP pinch. So what you do is you anchor the VWAP from a swing low, you anchor the VWAP from a swing high, and you can see how well that the price starts trading within this channel or this zone, kind of like if you're looking at Bollinger Bands and how they're getting tighter and tighter. That's pretty much what this is showing, except it's a volume-weighted average price rather than just a Bollinger Band looking at standard deviations around
so we are basically 20. Like waiting for a breakout or breakdown from here, from this pinch.
Exactly. And what you can also do is you can anchor the volume by price, what we just talked about. Generally, you want to anchor the volume by price from the same point. And so you'll see here that there is quite a bit of shares holding within this general area. If the price is able to kind of move up from here, notice we have this little volume gap here.
Yes.
So if the price did start moving up, maybe we move up pretty quickly through this area, and then we're back to this next supply zone here. And remember that we call it a supply zone because at the current price of $77.60, these shares are technically holding at a loss. So we call it a supply zone because it's initially going to act as supply for those that maybe want to get out and trade something else. And so that's where we call these supply and demand zones.
Right.
So this is all about making the process more efficient. Before I was able to anchor the volume by price, I had to go in, just turn it off. I had to go in and use the volume. And I'd have to go and say, okay, well, there's a big chunk of volume right here at this candle. And then I would go in and I would extend this candle over to highlight, okay, this is a big area of volume. So the volume by price is doing that for us without having to go in and measure where these big volume blocks are.
Right.
And so it's really about making the whole process more efficient. And that's something that over time as a trader I've realized, being efficient in trading and technical analysis is very important. It really allows you to focus on what you need to focus on rather than taking an hour to create a chart. And so that's something we're really focused on at TrendSpider is making the whole process more efficient. So one last thing I'll go over is being able to use technical analysis and seasonality together. So Tesla is a really good example of this. If we go to Tesla and we kind of look at the overall price of Tesla, there's a few things that are a little worrisome here on the monthly chart. One, the month of September is not over, right? So there is still time here. However, there's enough. What's today? The 21st. So we have about 9 trading days left, which is when you want to start looking at the monthly candle to just get an idea of what it's looking like. So what's interesting here is, one, we have this hanging man set up. Who knows? It could close. We could close down here around 338. We could close here at 764. Nobody knows. What we can do is just kind of look at this and monitor it. Now, what's interesting is if we start the volume by price from the initial IPO for Tesla, what are we seeing here? We're seeing that a majority of shares are holding way down here. So a majority of participants in Tesla are holding at like a 700, 800 profit ROI. Okay. And what we just talked about before was it's a lot easier to sell something when you have a lot of profit. So what happens if all these shares start selling, that adds to the selling pressure up here. And remember, this also is telling us that there's really no volume at all supporting price up at the current area. It's flat. So most of the volume is down here, and there's not a lot of volume supporting price. Now, this can absolutely happen where the price breaks down, some of these people start to take profit, and these shares that were distributed down here may start getting distributed up here, because then a buyer comes in and starts to buy here. That can actually make, you could see a little volume bar. Let's make it gray so it looks like the other one. But you could see another volume bar pop up here. If all of a sudden a bunch of buyers come in at 162, 150, whatever you want to call it, they could technically, because this volume by price is not set and it doesn't change. It changes all the time. So there could be a time where buyers step in and a new volume shelf is formed, and this acts as a support zone. Very possible. So it's more or less taking the chart for what it is now and kind of applying your strategy, however that strategy is. So not only do we have a hanging man, not only do we have a very low amount of shares supporting price up here, but we also have something called seasonality. And seasonality is something that is a widget. And essentially, you can go to add new widget here, go to seasonality, and we can actually see, over time, how has Tesla performed. So since the start of Tesla, the IPO here in 2010, September and October have not been great months. This 36% and this 40% tell us that only 36% of these Septembers over the last decade have closed green for the month. And then you go into October and it's 40%. So you kind of have an edge on the bearish side here, just looking at seasonality, but you're also applying this hanging man. You're also applying the fact that there's not a lot of shares supporting price up here. So being able to use technical analysis and seasonality together can really give you quite an interesting view in the markets, make that whole process more efficient, and help you become a more disciplined trader and a trader that's really just sticking to their plan and not deviating away from it. Whether that's looking at technicals, whether that's looking at seasonality, all of these tools are here to make the process of trading and technical analysis more efficient.
Perfect, perfect. Actually, I have seen that these seasonality, I've seen in India, like some guys are actually, they are manually backtesting it, and then they are making an Excel file for this, and then they are searching it. So this is like automatic for that also. There's a really nice tool.
Yeah, so if I was doing this manually, first I'd have to say, okay, since I'd have to look on the chart. All right, since January 2014, and then I'd have to go in and look at every single September, highlight that September, do that for every September. Within the 30, 10, 15 seconds that it just took me to do this first part, I could have just said, all right, I want to look at what's since January 2015. Only 17% of September since January 15 have closed green. So this is historically not a good month, whatever time frame you're looking at for Tesla. And so, as you mentioned, instead of manually doing this, the system's doing all the grunt work for you.
Right. And one last, like, can we see the Nasdaq chart, current chart? Because many are like the fall that recently came. So many are like disturbed from that fall. So they really want to know what's in that Nasdaq chart.
All right, so I'm just going to use the Qs as a proxy for NASDAQ here, and we'll see here, September is one of the lower months. For only 45% of Septembers since 2010 have closed green. And then you go into October, November, and you see that rate of winning, that I don't want to call it a win rate, but it's historically how many times has October, November been green. It spikes. So since 2010, 70% of Octobers and Novembers have been green, and then you go into December, which is kind of 50-50. So for me personally, let's say that we want to anchor the volume by price from this big capitulation, 2015. This was when the oil market crashed, and the market just had a huge flash crash. But the same thing with Tesla, right? Since 2015, a majority of shares are holding down here in the 180s to the 160s. We're up at 264, and you can see, yes, maybe some little blocks of volume are starting to come in here and form, but a majority of people since the 2015 crash, a majority of these shares are still holding at a 40 to 50% profitability, ROI. And so it kind of goes back to, all right, there's a lot of people holding in profits. It's very easy for people to sell at a profit versus selling at a loss or break even. And so, sometimes you'll see a discrepancy where you've got this big engulfing candle on the monthly, but you still have, October, November being slightly more positive than negative. Sometimes you have to get an idea of, what's the current status quo of the market. Elections are coming up. Not every September since 2010 or October has been an election year or election month. So those are all other things that you have to consider as well when looking at these types of things.
Right.
So hopefully this video helped, one, understand, a little bit of my background in the markets and how I got involved. And, hopefully this also helps you guys see a different perspective in the markets. And if you guys have any questions, feel free to reach out. At TrendSpider is our Twitter. We have our DMs open. So if you have any questions, Indian data on the platform. So that will be a huge win for us when we finally do get that. So if you're seeing this and think it's cool, but you're not really trading the U.S. markets, definitely know that we are working on getting Indian data into TrendSpider for those that trade the Indian markets to be able to use this software as well.
Yeah, actually, I've discussed this with a few of my friends, and they're like really interested. They are just waiting for Indian data to come over here.
It will come, I promise. It's a project we're working on right now, and we definitely are excited to get it out to new traders in the world, and really offer a perspective that's really not out there in many platforms. And hopefully over time, you guys will see the value in it, using it in different markets, and we'd love to have you as a customer and a subscriber. So once again, the free trial is in the description, as well as the supply and demand video that I was talking about. You can definitely check that out as well to understand some of the theories behind what we went over today. So thank you, Harneet, for having me. This was a great video, and really appreciate every time you have us on or showcase TrendSpider.
Thank you. The pleasure is mine. Thank you so much for like coming on my first request. You like accepted my request that you can, okay, you will share your journey also, and you will share all the different strategies of raindrop charts from anchored web. So I am sure when I'll publish this video, all of my friends, all my followers, they will actually gain a new insight towards the market. And this seasonality thing, this is also a huge thing. So I'm sure like this video is going to like be a like game changer for many of my friends. Thank you so
I
much.
love it. I love it. Well, that's why we did the video, and hopefully it does change the perspective of some out there.
Right,
And if it doesn't, that's not a bad thing either. We all have our way of looking at the markets, but
right.
this is really looking at the supply and demand side of the markets and that type of thing. So thank you again for having me on, and looking forward to doing another video like this soon.
Perfect. But yeah, I'll definitely bother you for the second part of this.
Yeah, definitely. Whenever you want. There's plenty of other things to go over as well. So
Yeah,
we really just scratched the surface on this video. So definitely looking forward to the next one.
perfect. Perfect. Thank you so much once again. Thank you so much.
Hey, thank you.
Thank you. Bye bye.